Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Double dissent. The Fed holds rates as expected, with Governor Stephen Miran and Fed Chair hopeful Chris Waller calling for a cut. Gold, silver and copper all hit fresh record highs. Tesla, Meta and IBM gain on strong numbers and plans for artificial intelligence, but investors punish Microsoft over worries about returns from its soaring capex. And it's a big day for earnings in Europe. SAP announcing a €10 billion share buyback and forecasting growth in cloud revenue. The focus now shifting to the continent's lenders, and we'll be speaking to the Deutsche Bank CFO this hour. A very good morning. Welcome to Thursday. The picture in markets looks like this. We did have the Bloomberg Dollar Spot Index rebounding yesterday off comments from the US Treasury Secretary Scott Bessent, publicly contradicting his boss and saying that the US is for a strong dollar policy and saying absolutely not will the US be intervening in the yen. But now we've got the dollar on the back foot again. So euro dollar higher at 119 at the moment. This thanks to President Trump's threats on Iran, but also the Democrats' threats of a US government shutdown, a partial one. Now, what likes all of this? Gold, of course. We've got gold past the $5,500 an ounce level now. It's reaching for $5,600. And we've cleared a key level on the S&P as well, this 7,000 level. And we've got futures pointing higher on both sides of the Atlantic this morning. In terms of the risk events that could change all that today, on the docket, we do have at 1:30 p.m. London time the latest US jobless claims numbers, and it's a massive day for earnings, as I say. We continue with the Mag 7 earnings stateside. We had mixed signals coming from the three that reported yesterday, but Apple comes later on today. And this side of the Atlantic, a massive day for European banks. We're going to be hearing from Swedbank, ING and also Lloyds Banking Group. This, of course, was the best performing sector last year in Europe, and it seems it's got the wind at its sails this year as well. More on that in just a moment. Let's set you up for the day ahead. Well, it is a massive day for earnings on both sides of the Atlantic today. Here in Europe, we kick off with breaking earnings from Deutsche Bank. Of course, Deutsche yesterday was raided by German authorities as part of a money laundering probe, that knocking the stock yesterday. So reopening an unsavoury chapter for the CEO, Christian Sewing, that he had hoped to close. But this morning, Deutsche Bank is reporting that it's authorised a €1 billion share buyback. That red line crossing the terminal earlier. For fourth quarter net revenue, it comes in at €7.73 billion, so just beating the estimate of €7.64 billion. They say that they expect full year 2026 revenue to increase to about €33 billion, and they're beating estimates for fixed income trading. We're going to be speaking to the CFO, James von Moltke, later on this hour. That interview coming at 6:30 a.m. London time. But now we switch over to Switzerland, a read on Big Pharma from Roche. Their earnings also just crossing the terminal. It was expected to be hitting its full year targets, even as currencies and its diagnostics units have remained a drag. They see 2026 group sales growth in the mid-single digit range, and they're looking at fourth quarter diagnostic sales of $3.54 billion. So really almost in line with estimates here, but the focus very much on this year because Roche has got new drugs, it's cracking the whip on cost discipline, and of course you've also got that hype picking up around its obesity drug. We're going to be speaking to the CEO of Roche, Thomas Schinecker, and that conversation also coming on the opening trade at 7:40 a.m. London time. But let's now also switch over to Nokia, earnings breaking from them in Finland, the telecoms giant, of course. Unlike some rivals, it's been leaning heavily into AI, so taking money from Nvidia, and now the focus very much on how that pivot away from providing telecoms equipment is going. The stock up about 10% from a December low, and what you're seeing is fourth quarter adjusted operating profit coming in at €1.06 billion, bang in line with estimates there for Nokia. And we're also going to be speaking to their CEO. That's Justin Hotal, and it's coming at 8:30 a.m. London time. Finally, earlier on this morning, we also had earnings from SAP. I told you it was a busy one. We've got Europe's most valuable software company forecasting cloud revenue to grow in 2026 as we have customers switching from the older tech ahead of a deadline to stop servicing legacy clients. And we'll be speaking also to the SAP CEO this morning. Christian Klein will be speaking to the opening trade at 7:30 a.m. UK time. Well, let's get back to the macro now. The focus also on Fed Chair Jerome Powell's decision to hold off on an interest rate cut, long sought by President Donald Trump. In his press conference, Powell emphasised that the decision was supported by most of the FOMC, despite dissents from Governor Stephen Miran and Governor Chris Waller, who, of course, is in the running to replace Powell as Fed Chair.
There was broad support on the committee for holding today. Broad, I would say, including among non-voters. So that's where that was. Of course, some people did want to cut and dissented, but committee pretty broadly for holding today.
Powell also defended the Fed's independence, which has come under sustained attack from the president.
And we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important, and the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
You're confident it can maintain that independence at this point?
Yes. I mean, I'm strongly committed to that, and so are my colleagues.
Let's bring in Mark Cudmore, Bloomberg's MLive executive editor for analysis now. Morning, Mark. You had Governors Christopher Waller and Stephen Miran both dissenting against the Fed's hold yesterday. But should we be worrying less about whether Waller's vote was politically motivated and focus more on this being a hawkish hold, given that Mickey Bowman, once a dove, fell in line with the majority?
Good morning, Lizzie. I definitely think that is one way to interpret this, that, you know, it was very interesting that Bowman did not dissent, as might have been the expectation. And I came in this morning excited to latch onto that fact and that this was a hawkish hold. But really, we're stretching here. This is a meeting where we expected almost nothing. And you know what was so surprising is he managed to outdo our expectations by delivering less than nothing. He refused to get drawn into many of the controversial issues. And it's really, really spectacular how rates positioning basically has not really changed. We're still trading where we were a week ago. There was almost no impact on markets. And that's been a pretty rare event under a Fed meeting under Donald Trump. So I think Jerome Powell did a spectacular job of causing no ripples at all, no reaction, no impact. Move along now, wait till the post-Powell Fed.
I think Mervyn King once said the job of modern central banking is to make it as boring as possible. So sounds like Jay Powell managed to achieve that for you, Mark. Look, while the dollar is back negative against its major peers, despite these comments from Scott Bessent yesterday, gold, copper and silver have all hit record highs. How much is that the debasement trade, and are the metals ripe for a nasty come down here?
So, two questions there. One is, I think a chunk of this is definitely the debasement trade. I get a little bit nervous about that term, but it is valid to some extent. People are looking to diversify away from the US dollar. This is not about the end of the US dollar as the world's main reserve currency. It's just about they've been massively overexposed and they're looking to reduce that exposure. Now, there are the other major fiat currencies out there aren't looking particularly attractive. In the mid-2000s, when we went through a phase of trying to diversify away from the dollar, we were getting very excited by the euro, which was kind of fresh and new and looked like it was really uniting well. We were getting excited by the yuan, which had joined the WTO. The Chinese market was booming. Its assets were booming. And we even were much more positive about the yen. We didn't realize it was still in the early stages of 3 decades of stagnation. So I think there were many exciting options back then, and we really got excited about emerging markets. It was the rise of BRIC. Today, people haven't been burned on these kind of narratives before, are not as excited by the counter narratives. So they're like, we can increase exposure to some of these other currencies, but they're not great alternatives, which is why they're piling into real assets. They're basically worried by the fiat currency idea, which is where we get the debasement trade idea. So they're looking for real assets, and precious metals are both benefit from being a kind of a real asset, but also by that idea that they are haven assets. They benefit from uncertainty, from risk aversion. They've got a historical record of being sometimes stepping in as currencies. So absolutely, what's happening in metals is about that. You ask whether they're ripe for a drop. The rallies of the last couple of months have been truly extraordinary, particularly in silver, more so than gold. But you could have said they looked ripe for a collapse at any point since December, and they've gone another 30-40% since then. Sorry, more than that, apologies, because I think silver's actually up about 60% year to date. The moves are happening so fast I can't keep track. So I think that they look really overextended, but you know what? The people who have lost money here have been the people trying to pick the tops. I think we're in a frothy end game. That does not mean you start shorting it today.
FOMO. All right. Mark Cudmore, Bloomberg M Live Executive Editor, thank you so much for those insights. We're getting back to earnings. In US tech earnings, the social media giant Meta gained after posting record sales and a strong forecast. But it's a different tale for the world's largest software maker, Microsoft, of course. Its shares plummeted over concerns that the company's AI investments could take longer to pay off.
Our North Star is building the best place for individuals to make a massive impact. So to do this, we're investing in AI native tooling so individuals at Meta can get more done. We're elevating individual contributors and flattening teams. We're starting to see projects that used to require big teams now be accomplished by a single very talented person.
In Azure, we expect Q3 revenue growth to be between 37% and 38% in constant currency against a prior year comparable that included significantly accelerating growth rates in both Q3 and Q4. As mentioned earlier, demand continues to exceed supply, and we will need to continue to balance the incoming supply we can allocate here against other priorities.
Bloomberg's opening trade anchor Tom McKenzie, also host of Bloomberg Tech Europe, joins me now for analysis. Tom, two very different stories from Meta and Microsoft yesterday.
Yeah, I think if you want to draw a comparison between the two, investors are looking at these two businesses and saying, and most of them Mag 7, and saying, look, is the core business working? And if so, we can allow you, we'll be relaxed. We will reward you, in fact, if you spend heavily on capex. And with Meta and Microsoft, you had very different outcomes as a result of that. So let's start with Microsoft. So Azure, we heard from the CFO there talking about that. That's the key part of the business in terms of the cloud business for Microsoft. And the growth slowed. The revenues were up about 38%. That sounds good. But when you compare that to the spending commitments from Microsoft on capex, 66%. So 38% growth in cloud, but 66% commitments in terms of the growth of capex. And it's that divergence that is causing investors concern when it comes to Microsoft. The core part of the business, the cloud business, the Azure business, is growing, but not as fast as many would hope. And yet the capex commitments from Microsoft are being extended further, up 66%. So that is the concern on Microsoft. When it comes to Meta, the core part of the business is firing on all cylinders. You saw that in the holiday quarter. You see that in the guidance for the current quarter. They're performing very well in terms of advertising. That is the core part of the Meta business. They are failing when it comes to the models. They are losing that race. But the core part of the business continues to churn out profits, and that is allowing them, from investor perspectives, to spend heavily on capex. Talking of the spending commitments, Meta is looking to spend potentially up to $135 billion this year alone on capex. But for investors looking at the core engine of growth for Meta, which is advertising, and the way that AI is helping to accelerate that, that is the comfort blanket for investors around Meta's spend at this point.
OK, so it's worth it seems, when it comes to Meta in investors' eyes. Then we turn to Apple. They're reporting today. What are we looking for?
So Apple's really interesting in that it has really had to play catch-up on AI as well. Despite that, the iPhone 17 has been really well received. It's going to have a very strong quarter. In fact, it could be a record quarter for Apple, close to $140 billion in revenues because of the demand for iPhone 17. The China story is turning around a little bit for Apple, so that is likely to be a positive. And then the AI story could really come to the fore for Apple. They've changed the team. They've got a contract and an agreement with Gemini to supply their model and build that into Siri. That is a 2026 story, and that could really turn things around. But for the here and now, it's about the numbers that come through and the numbers that will come through in terms of the holiday season and how they guide into the future. I think questions about the cost is going to be interesting because we've been talking about the metals pricing coming through from Mark Cudmore. We're seeing the increase in components and memory chips. Is pricing going to be more of a challenge for Apple into the rest of this year? That will be a question for executives. But it's about the iPhone 17 and it's about the China market for now is what the focus is going to be when the earnings drop later.
We've got SAP here in Europe already having reported this morning. What are the top takeaways?
Yeah, it wasn't long ago that SAP was the most valuable company in Europe. It's fallen quite some far distance from that. Part of this is concern it's becoming a more competitive space. There's a lot of incumbents in the software space and the AI space that are starting to chip at the heels of SAP. This is focused on enterprise. What they're saying is that for the growth of 2026, they continue to see that as their enterprise clients move from licenses, on-premise licenses, to subscriptions in the cloud. That's been a big driver. Investors have backed that all the way. But are we getting to the end of that? Does that continue into 2027? What is the backlog for SAP? The growth story is there in terms of the numbers, in terms of their forecast for 2026. But I think the CEO, when we speak to him on opening trade, those are some of the questions I'll be putting to him. Certainly, there are still questions for SAP.
Well, you've got a busy morning ahead of you, so I'll let you go. That's Bloomberg's opening trade anchor, Tom McKenzie, and he'll be back at 7 a.m. London time with a raft of interviews this morning. But staying with that tech theme, we've seen some outsized moves around Asian tech stocks this morning, Samsung and SK Hynix. Let's go over to Winnie Su in Hong Kong now for a snapshot of Asia markets. Winnie.
Yeah, morning, Lizzie. As you mentioned, we actually got pretty strong earnings from both Hynix and Samsung. But the interesting part is that stocks really seeing some profit taking after that small pop at the open, and a bit of dip buying following that. So you can see that really fluctuating a bit. When it comes to the Korean one, actually gaining more strength because these earnings actually point to a brighter outlook when it comes to exports. Now, also flip the board and take a look at the broader Asia market, because another key market that we're watching closely is the Indonesia market, which is pretty much still in that free fall, and we are headed for the biggest two-day decline since in 3 decades, and that is coming after how Goldman Sachs and UBS both cutting and downgrading the stock market, also pressuring the currency here. Now, also flip the board and take a quick look at the property market, because Chinese property stocks under quite some pressure because of the local report saying that developers no longer need to report these monthly 3 red lines, and that were these key indicators that were designed for debt control. Back to you, Lizzie.
Winnie, thank you so much. That's Winnie Su in Hong Kong. Well, as I say, we've got a massive day on our hands for European earnings. We're going to be hearing from the CEOs of SAP, Roche, Lloyds Banking Group and Nokia. But coming up right here on Daybreak Europe, the British Prime Minister meets China's Xi Jinping in a bid to broaden trade ties, and we'll discuss whether he can do so without incurring the ire of President Trump. That's next. This is Bloomberg. Good morning from London. The UK Prime Minister is calling for a more sophisticated relationship with China after meeting with President Xi Jinping in Beijing. It's the first trip to China by a British leader in 8 years. And for more on that visit, Bloomberg's chief Asia correspondent Rosalind Matheson joins me now. Ros, this doesn't sound like the beer-clinking days of David Cameron when he was trying to warm up China. It sounds quite cold, actually. Starmer saying that the two sides will have to manage their differences. What have they discussed so far?
As you say, it's not exactly a pint of beer down the pub, a la David Cameron, and perhaps there isn't that natural rapport between Keir Starmer and Xi Jinping, but you can see at least a bit of recognition from both sides of the benefits of having a little bit of a reset, at least putting a floor under the relationship. And as Starmer and others are saying, managing their differences, agreeing to disagree while focusing very much on trade, investment and business ties. You can see very much that's going to be the focus of this trip. Starmer taking a large delegation of business leaders with him, including university leaders, perhaps hoping to get some business there from the lucrative Chinese student market that might no longer be going to the US. And of course, Starmer did prepare a gift for Xi Jinping. It might not have been a pint of beer, but it's a football, a ball from a football match between Arsenal and Manchester United, and Xi Jinping known to be a football fan. So a bit of an effort here, but also a recognition that they still do have their differences. And you can see that in some of the comments made by Xi Jinping. So both sides looking to get something out of this on the business side, but also the diplomatic side. I mean, Xi Jinping has just literally said he is willing to consider visa-free travel for British citizens. That would be a win, obviously, for Keir Starmer as well. And then some specific deals that may come on the business front, particularly when this visit moves to Shanghai and some of these CEOs get time with their Chinese counterparts.
I'm reliably reminded that beer clinking happened in Cameron's local pub, Ros. Thank you so much for the latest on that visit. That's Bloomberg's Rosalind Matheson. Well, coming up on the programme, oil advancing for a third day after President Donald Trump warns Iran to make a nuclear deal or face military strikes. We'll get you more on that next. This is Bloomberg. Now to some of the top stories we're following this morning. President Trump has warned Iran to make a nuclear deal with the US or face military strikes, even worse than last year's. In a social media post, Trump says the fleet he's ordered to the region, led by an aircraft carrier, is ready to fulfill its mission with speed and violence if necessary. Iran's UN mission responded on X, warning if pushed, the country will defend itself and respond like never before. Oil climbing following Trump's Iran warning. Elsewhere, the US Secretary of State says that the Trump administration won't hesitate to use force if Venezuela's acting president doesn't cooperate with the United States. Marco Rubio told lawmakers they won't leave her government in place indefinitely and that the US wants to see the country return to a democratically elected government. It's the first time Rubio has testified before Congress since the raid capturing Nicolas Maduro on January 3rd. And US, Danish and Greenlandic officials have begun talks on a new framework for Greenland as Washington looks to address President Trump's demands for a stronger American presence in the Arctic. Danish officials say they're ready to negotiate and review cooperation with the US on Greenland as long as it stops short of questions about the island's sovereignty. And Senate Democrats are demanding new curbs on President Trump's immigration crackdown in exchange for their votes to avert a looming US government shutdown. The demands include restraints on use of force, a ban on masking agents, plus the use of body cameras and better cooperation with law enforcement locally. Anger has grown after ICE agents shot and killed 2 people in Minneapolis. Those are some of our top stories around the world, but coming up on Daybreak Europe, we'll get back to earnings. Deutsche Bank closing out a record year with a new €1 billion share buyback. We'll be hearing from the CFO, James von Moltke. That interview coming up next. Stay right there. This is Bloomberg. Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Double dissent. The Fed holds rates as expected, with Governor Stephen Miran and Fed Chair hopeful Chris Waller calling for a cut. Gold, silver and copper all hit fresh record highs. Tesla, Meta and IBM gain on strong numbers and plans for artificial intelligence, but investors punish Microsoft over worries about returns from its soaring capex. And it's a massive day for earnings here in Europe. Deutsche Bank announcing a new share buyback just one day after a raid on the lender's Frankfurt offices. We're just diving into those earnings from Deutsche Bank. We had fixed income sales and trading revenue beating estimates. As I say, they're planning this €1 billion share buyback. The CET1 ratio, a key measure of financial strength, of course, was down slightly, but still within the target range. And you had the bank saying that 2026 so far does support the revenue trajectory and their investment plans. Now, all of these lines coming after Deutsche Bank was raided by German authorities as part of a money laundering probe. And that probe looking at past dealings with firms linked to the now sanctioned Russian billionaire Roman Abramovich. That knocked the stock yesterday. It was down nearly 4% in Frankfurt at one point, but closed down 2%. And really reopens an unsavoury chapter of scandals and losses that the CEO, Christian Sewing, had hoped to close. Now, in a moment, we're going to be bringing you an interview with the CFO of Deutsche Bank. That is, of course, James von Moltke. He's set to depart the bank. He'll be replaced by Raja Akram, who joined the bank in October from Morgan Stanley. So let's get to that interview now with our Chief Europe correspondent, Oliver Crook, who sat down with the CFO.
2025 was a year of a lot of, in a strange way, volatility. I mean, the volatility measures that you see overall were down and relatively moderate, but within that, there was a fair amount of activity, and obviously making markets for clients, being willing to step into risk positions, providing good prices in moving markets is what we do, and the team under Ram Nayak did a fabulous job. Really strong start to the quarter. So it's really just, it started where it left off. And as you say, the events, obviously the market has reacted with, I'd say, sang-froid, if you like, to the geopolitical events that are going on. But nevertheless, if sort of pockets of the market, there are, of course, movements, and those movements create activity and some degree of volatility. That we aim to serve our clients. Well, we had one of our occasional visits from the prosecutors yesterday, and as you may have seen in some of the reporting yesterday, the investigation relates to transactions from the years 2013 to 2018. Naturally, we're cooperating as we do in each case with the prosecutor in their search, and we will continue to do that. We can't really say much in this early stage of the investigation. But it builds on earlier investigations on similar matters. Well, look, there's remarkable strength across risk assets around the world. As you say, some of the paradigms that we're used to, strong dollar and risk-off situations, allocations of capital around the world, including to the United States, of significant amounts, and then growth paradigms that we got used to. Those things are all changing in a world of uncertainties around the geopolitical alignments, the impact of AI, still a high degree of liquidity. So investors, I think, are reacting to some of those paradigm changes. For us, obviously, we're positioned, I think, to help in reallocations to Europe as they take place. We're very focused on acting as a gateway to opportunities to invest in Europe, and obviously helping Europe to finance all of the investments that are needed here, whether that's, again, AI, defense, infrastructure, digital transition, also the sustainable transition. These are all things that are still going on and where Europe will require immense capital investments.
And I think probably saying sell America slightly overstates what's going on, but there's been, different kind of characterizations of trying to describe what's happening. There's one that's sort of quietly quitting America, i.e., diversifying away. Are you seeing that represented in Europe? Are you seeing clients moving more, or is that not?
I'm not sure I'd use those words, but I mean more thought given to, for example, if you're a non-dollar investor, do you hedge your dollar positions? You're going to be invested in the United States for sure, but do you need to hedge the currency? That is a question. Seeking growth outside the United States. There has sometimes been valuation differentials for companies in similar circumstances between the United States and outside. So there's, put it this way, looking for value, but it doesn't mean instead of the United States as an investment destination.
And then also, as we sort of think about the corporate world getting further and further enmeshed, sometimes not sort of by their own desire with politics. We saw last week a note that came out of Deutsche Bank that obviously did the rounds around Davos about Greenland and the risks associated, and the idea that basically Europe is a large creditor to the United States, and then that could at some point be used as a point of leverage, which is just a fact that one of your analysts pointed out that prompted a call from the CEO of Deutsche Bank to the U.S. Treasury Secretary to kind of distance itself from it in a certain way. I'd like to just get your perspective on that and whether we're living in a time now where independence of research is coming into question, or is that something that in your mind is rock solid? No, I mean, it's rock solid. The independence of research is absolutely sacrosanct. I think our research is just outstanding, and David Porkos-Landau runs a great team of independently minded analysts who I think come up with great sort of ideas and analysis for investors, and it needs to be independent. Sometimes it can be awkward for the corporations, the banks that sponsor the research, but that independence is absolutely as it should be.
That was the Deutsche Bank CFO James von Moltke off the back of that bank's earnings, speaking to our Chief Europe correspondent, Oliver Crook. Well, just as that conversation was happening, we did have some breaking lines on silver. In fact, the spot silver price rising to a record above $120 an ounce. Of course, we've already seen gold surging past $5,500 an ounce because of this lack of liquidity accelerating the rally fueled by the weaker dollar, this investor flight from sovereign bonds bonds and currencies that we were just hearing Ollie discussing there with von Moltke. And of course, we have been keeping a close eye on the dollar as well. Given the comments from Scott Bessent, the Bloomberg Dollar Spot Index is weaker by 0.3% today as well. We also have just had a headline crossing the terminal on Lukoil that it has agreed to sell its international assets to Carlyle. This, of course, is the Russian oil producer Lukoil. It says that it's continuing talks with other potential buyers. The deal is not exclusive, conditional, it's subject to approvals, and the deal doesn't include assets in Kazakhstan. So another one that we'll be monitoring closely. We've also just had breaking earnings from Sanofi. So this is, of course, the French drug maker. It's posted higher than expected quarterly profit, aided by sales of its blockbuster skin and asthma drug, and forecasting another year of growth for revenue and earnings. So a busy morning already when it comes to the earnings picture. Now, there's been volatility in Tesla shares as well after hours, after it reported ambitious capital expenditure plans and a beat in fourth quarter earnings. The CEO, Elon Musk, went further than expected, announcing $20 billion of expenditure to build factories for robotics and AI manufacturing during the earnings call.
I think in order to remove the constraint, the probable constraint in 3 or 4 years, we're going to have to build a Tesla Terafab, a very big fab that includes logic, memory, and packaging domestically.
Let's bring in Bloomberg's aviation and transport reporter Danny Lee for more. Morning, Danny. A huge capex announcement here from Musk. Why now? Why is he talking about building factories now, Danny?
Good morning, Lizzie. So Tesla has this huge vision that Elon Musk has talked about, really integrating AI into a whole suite of future Tesla products. So he needs the capacity, Tesla and Elon Musk needs capacity in terms of semiconductor chips. And the fact is that the likes of Samsung, TSMC of Taiwan, and Micron Technologies cannot give Elon Musk and Tesla the kind of supply that he needs in order to scale up. That's why he's been talking about on this earnings call about having a Tesla-made semiconductor factory that so far it doesn't seem clear that it has been accounted for in any kind of capex spending, which will cost many, many billions of dollars. And so therefore, by signaling to investors and to Wall Street that this is the direction he wants to go in, particularly as this really goes to the story of vertical integration, having greater control of your own supply chain, this is something that will really be something closely watched in terms of how then Tesla from here on in accelerates its capex spending and its investments, really doubling down on that AI story.
So where does it leave Tesla as a car company?
It's a really good question. We have heard Tesla and Elon Musk talk for some time now about this kind of AI trend it's pivoting to, whether it be on the Cybercab, the Optimus robot, and various other components. But when it comes to the EV space, it's really a flagging kind of space that Tesla's been really undermined when it comes to the Chinese competition. And when we heard announcements, the fact that it's going to be giving up on some of its products in the auto space and really streamlining its lineup, getting rid of the more expensive, low volume models that it produces, this is just a sign, even more of a greater sign of how it's going to pivot and really refocus on some of the newer plays and really help drive that valuation as the share price has got to some really elevated levels and kind of do away with some of the more difficulties in the traditional auto sector.
OK, Danny Lee, thank you so much. That's Bloomberg's Asia aviation and transport reporter, Danny Lee. Well, earlier on this hour, we reported on those earnings from SAP. They dropped at 5 a.m. London time, and it does look like SAP is going to be falling when the stock opens on the Xetra DAX. It's indicated lower, at least, on TradeGate, despite the fact that SAP announced a share buyback of up to 10 billion euros and forecast cloud revenue growth in 2026, with you've got clients switching away from from old to new technology. So SAP indicated lower on the Xetra DAX. Next up, we're going to be continuing with earnings. Switzerland's ABB projecting revenue growth and adding a share buyback of its own. We'll be discussing the latest numbers with the CEO next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:42 a.m. here in London. Now, ABB expects higher profitability this year as a boom in data centres drives demand for the company's power grid products. The Swiss industrial giant is projecting comparable revenue growth of as much as 9% in 2026. And we can speak now, I'm pleased to say, to the ABB President and CEO, Morten Wierod. Good morning, Morten. Thank you so much for making time. This is a pretty good set of numbers. You've got a $2 billion share buyback planned. What's gone right this quarter and what challenges are you seeing ahead in the next quarter?
Yeah, we were very pleased with the overall very strong performance of ABB in the fourth quarter. It ended a record year for the company, the best ever, with strong order revenue growth and also record profitability, especially in the fourth quarter with more than 30% order growth, top line growth. It gives us good pace into 2026. So we are also confident about this year because the electrification and automation of everything, that's where kind of sweet spot of ABB, and that trend that is just accelerating everywhere in the world.
And what proportion of your revenue is now coming from data centers and how's that business doing?
Well, the data center business is going very strong. In last year, we ended up, it's about it's a bit less than 10% of the overall company revenue. So it is it's an important part, but it's as I say, it's not the only part. But it is a strong growth driver for the company, and especially in our electrification business. So we are working on the infrastructure side, making all that power that is needed for these data centers, the electrification, the incoming power, and that they got reliable and secure power every day in data centers. But it's the all power generation. You know, we need more electricity for everything we do these days. And that's where we as a company are helping all our customers and all these segments on markets to electrify and automate everything. That's what we do at ABB.
But a lot of your data center orders are from the United States. How's the dollar weakness impacting your business?
Well, it's not the biggest market, more around 50%, a bit more than 50% of the market is United States. But we also have very strong data center business in Asia and also in Europe. The dollar doesn't impact us very much because we are also at ABB always producing close to customers. That's what we call a local for local strategy. It means that where customers are, that's where we serve them. And then you're able also to take some of the currency fluctuations, tariff, you know, all the things that happens on trades these days out of the equation. So it's important to be local, close to customers, produce there and serve them there. That's normally also how customers want to be served.
I understand that, but if this dollar weakness persists, Morten, is it going to be a problem for you? We have the president saying that dollar weakness is great.
Well, as I say, we produce in the United States most of these data center equipment, and what we sell in the United States is produced there. And that means that market, when it comes to pricing, when it comes to demand and supplies, needs to be balanced there. And that's how we expand capacity, because we see, just to give you an example, our business in the United States was up more than 50% in the order intake in the fourth quarter. So this shows a strength in data center, but it's really in the utility business, you know, more electrification, more LNG and gas project, all of this. That's the boom of the electrification automation trend in the United States as being one of the key market, but it's also for us, we see the same trend in Europe, where I'm right now, but also in Asia, in China, in India, and in Asia Pacific, to mention a few.
Okay, I think I'm right in saying, though, that your e-mobility business is still making a loss. What's your plan for that unit?
Well, e-mobility is still part of ABB, but we have announced earlier that we're going to do an IPO, and that plan remains unchanged. That's probably not going to happen this year because we need both the business as we have it, but also the market to be ready for an IPO. When those two boxes are checked, then we're going to move ahead, as we already discussed and planned.
Okay, well, you've said that you want to focus on M&A now that you've done the robotics sale. What are you looking to beef up in the business?
Yeah, we are looking at what could be nice additions to ABB. I say we are in good markets in electrification, automation, and we're looking at what could continue to strengthen our technology side, or also give us access to markets where we are not as strong today as ABB. So those are the two criteria what we're looking for. We have done quite a few M&A deals last year as well. We had an ambition to do 1% to 2% of revenue growth every year. We're not quite there yet, so this is one of the areas where we want to continue to improve as a company, building a stronger pipeline and making a bit stronger and bigger deals that were done in the past. And therefore, maybe just to give you a bit of a framework, the biggest deal ABB ever made was $4.2 billion for our Balder motor business. And we're not kind of afraid to do similar deals and that kind of size deals again.
We know that Novian Magnetics is supplying ABB with US-made rare earths. Of course, rare earths have become a geopolitical battleground, never seem to be out of the news. To what extent are your worldwide supply needs met here when it comes to rare earth magnets?
Well, we have, as I say, local manufacturing where we operate. And when it comes to rare earth material, it's kind of two sides. Either you secure your supply or you look at workarounds. And I think our motor business has done a great example where they're able to take out permanent magnet out of the design of their motors and rather use standard E-steel, but with a completely new design, what we call synchronous reluctance motors. So it's also possible to use technology to do design workarounds from some of these constraints in supply chain. So you have to work on both fronts here to make sure that you have that supply you need and to remain resilient so you can support customers every day. So this is an important topic for us. But as I say, we have a solid supply chain and a solid setup, but then we're also working on these technology workarounds. So that's kind of how we address those topics.
Just finally, Morten, our correspondent in Asia was talking earlier about the weakness in Chinese residential property. When do you expect to see a recovery in China?
When we look at our China business overall, we find growth there, but it not come in the building market. Buildings, and especially residential, will be quiet also in 2026. It's going to take time to recover. There are just too many empty buildings in China. I was there even in the weekend or beginning of this week. There are many areas that are good investments, good markets, but residential or some of the buildings market is not one of them, and that's going to take time. So I don't think we see any short-term recovery, but it is already on a very low level, and that will remain for, I think, 1 or 2 more years.
Almost crossing paths there with Keir Starmer. Morten, thank you so much for walking us through those results and your outlook with us. That's the ABB CEO Morten Wierod. Well, now to some other top corporate news this morning. Norway's $2.2 trillion wealth fund has slashed its stakes in the largest US tech firms, including Nvidia, Apple, Microsoft and Alphabet. Norges Bank Investment Management, which oversees the fund, cut more than 1,000 companies in the last 6 months of 2025 as part of a strategy to simplify its portfolio. And IBM shares jumping in after-hours trading after it reported quarterly sales that beat analysts' expectations on strong growth in its software unit. Sales climbed 12% in the quarter, with software accounting for the biggest proportion of revenue. Investors are enthusiastic about IBM's strategy to target high-growth software through acquisitions. Staying with tech, the Nvidia boss, Jensen Huang, says that the company still hasn't received orders from Chinese customers. But he told reporters in Taipei he's optimistic that Beijing will allow purchases of H200 chips.
I'm hoping that also the Chinese government would allow Nvidia to sell in H200, so they have to decide. And I'm looking forward to a favorable decision. I think that H200 is very good for America technology leadership. It's also very good for the Chinese market, and the customers would very much like to have H200. And so I'm looking forward to a good decision.
Plenty more coming up. We'll take you through the risk events on the docket for the day ahead. This is Bloomberg.
there's just a lot of uncertainty. And really, in some respects, it feels like the Fed's job is actually quite easy because you're looking at a pretty strong growth trajectory. We know somewhat where inflation is. The markets are extremely confused.
Right now, things look pretty good. On Monday, I said that the yield curve looked about as perfectly priced as you could have it. So does the bond market. It seems to incorporate reasonably good economic activity this year. It seems to incorporate what we think could be disinflationary forces coming from both the headwinds of tariffs on spending and also the impact of AI.
I think the big takeaway on the policy side was the removal of the balance of risks from the labor market assessment.
I think it's a Fed that is comfortable with the backdrop of data, which I think is the right call. The data seem to be improving from here. We actually think that it will continue to get better, in which case this will certainly be the last cut under Chair Powell. There's no more cuts under Chair Powell. He's done.
Bloomberg guests reacting to the Fed decision to keep rates on hold, all very politely, basically saying it was a bit of a snooze. So no rate change there, no updated forecasts for the outlook ahead, and no market surprises, really. But if you were looking for intrigue, it came in the form of the vote split. Of course, we had dissents from Governors Christopher Waller and Stephen Miran. And just take a look at how the odds of Christopher Waller replacing Jerome Powell as the next Fed chair have changed off the back of his dissent. Christopher Waller here is the yellow line, and indeed those odds have ticked up. So was the timing political? Our opinion columnist Jonathan Levin says that there'll be a price to pay both for Waller himself and for the institution because of that dissent. But flip the board over, because you could say that the politicisation of the Fed, or the perceived politicisation of the Fed, is feeding into the debasement trade, and we have got gold and oil rallying as well. But this comes back as well to the geopolitics. We've got the armada of Donald Trump's advancing towards Iran, so we keep an eye on that. But we also keep an eye on the earnings picture. It has been a massive day for earnings already here in Europe. Flip the board, and here we have some of the Mag 7 reporting yesterday. You can see that Meta and Microsoft have been trading in relative lockstep. It was a very different picture from those two names yesterday, but actually the white line here is Meta, and it managed to close the gap in after-hours trading. In terms of the risk events on the docket for today, we've also got Apple reporting earnings. We've got a raft of European banks reporting as well. And then at 1:30 p.m. London time, it's initial jobless claims numbers coming out of the US. We've got a lot to come on Bloomberg TV today. We're going to hear from the CEOs of SAP, Roche and Lloyds Banking Group and Nokia as well. They'll all be on the opening trade with Anna, Guy and Tom, who'll take you to the market opening. This is Bloomberg.